to FM with Sir Evans. In today's session, we will discuss the first part of the second competency in the syllabus of ICA Paper 2.4, Financial Management. Let's get started. So we will go with the financial management framework. We'll be looking at some sources of new finance for companies. So when a company is looking for new finance, there are a number of sources that the company can look out for. So the first is banks. So banks can provide short-term lending facilities, such as overdraft or even longer-term loans. Capital markets, this is where companies can have access to longer-term sources of finance, such as issue of shares and bonds. Money markets, they serve the short-term financial needs of the company. Now, there is this concept known as financial intermediaries. It's a person or organization that operates between savers or investors and borrowers. So they redirect funds of the savers and investors to those who need to obtain such funds. Now, banks as financial intermediaries, they take deposits from customers and lend this money to other customers in the form of bank loans and bank overdraft. This makes them important financial intermediaries because they are a major source of debt finance for many companies and individuals, and they also create new credits. So banks accept deposits in smaller quantities, and then they lend larger amounts to borrowers. Now, they also provide maturity transformation, which means that they transform deposits, which are short-term in nature, to long-term loans. Now, there is also risk transformation for the savers. So banks become those who are exposed to the credit risk from the borrower. The depositor's credit risk would therefore be limited to the risk of insolvency of the bank. So when investors put their money into financial investment, they are also expected to receive a return on this investment. So they also accept some level of investment risk, which is the risk that the returns will not be as high as expected. So other financial intermediaries are investment and commercial banks and stock markets. So what these do is that they accept what the investors have, and then they redirect it to those who need them. So investors will demand a higher return for putting their money into higher risk investments. So each investor will therefore have to build an investment portfolio that appears to provide a suitable balance or trade-off between a risk and a return. Now, there is a term called the separation theorem, which is the act of separating the risk and the return characteristics of market investments from the individual investment decisions of investors. So we'll now look at some financial markets. So financial markets can be classified as capital markets or money markets. Capital markets are for primary issues and secondary market trading in long-term investments such as equities and bonds. Now, a primary market is for selling shares to investors for the first time, while secondary markets are for sale of shares already owned by investors, or they buy those already in issue. So some functions of capital markets is a system for trading shares and ensures that there is fair trading among the participants of the capital market. There is also an efficient system for new financial information. And then in the capital market, there is also a system for recording of information. Now, money markets, they are wholesale markets for dealing in short-term lending and borrowing and for short-dated financial instruments. So the main money markets we have are the interbank market and the repo market. The interbank market is for borrowing and lending large amounts of money for a short term, but up to 1 year. And a repo is a sale and repurchase transaction where one party sells a quantity of short-dated bonds or money market securities to the other party, and at the same time undertakes to buy them back at a specified future date at a higher price. So some functions of money markets are: one, they provide short-term liquidity to meet the needs of the entity. And they also provide investment opportunities, which are for short-term. So entities with surplus liquidity can invest them and recoup them when they are in need of it in the short term. So we will now look at some money market instruments. We have the coupon-bearing instruments. So they have interest payable at a stated interest rate or coupon on a fixed amount of principal. And discount instruments, the borrowers will pay a fixed amount of principal at maturity, and it is issued at discount to its face value. Bills of exchange is a form of promise to pay a stated amount of money at a date in the future. It is issued by the drawer and accepted by the drawee. Treasury bills, they are short-dated securities issued by a government when money is needed to meet short-term financing requirements, and they have maturity periods from 90 to 182 or 364 days or higher. Bankers' acceptance, they are used when a company intends to borrow amounts of money for a short term over a period of time in the future. Certificate of deposit is a certificate issued by a bank stating that the bank is holding a specified quantity of money as a term deposit on which interest is going to be earned at a specified rate. Commercial papers, so they are unsecured promissory notes to pay a specified amount of money on a specified date. And the last one are derivatives, which are financial instruments whose value changes in response to specific underlying assets, requires little or no initial investment, and is settled at a future date. Now, there is this term known as the efficient market hypothesis, which says that the market cannot be beaten because it incorporates all important information into share prices. So stock trades are at the fairest value. Now, there are certain versions of the efficient market hypothesis. We have the weak form, which suggests that today's stock prices reflect all the data of past prices, and that no form of technical analysis can aid the investors. The semi-strong form, which submits that because public information is part of a stock's current price, investors cannot utilize either technical or fundamental analysis, though information not available to the public can help the investors. And we have the strong form, which says that all information, public and not public, is completely accounted for in current stock prices, and no type of information can give an investor an advantage on the market. Okay, so as we move on to sources of finance, they are saying that the requirement of finance can be broadly classified into two parts. We have the long-term financial requirements or fixed capital requirement, and this is needed to acquire land and building, and also long-term finances to finance long-term projects. So purchase of a plant and machinery, construction of a company office, those are all fixed expenditures that the long-term financial requirements will satisfy. And we have the short-term financial requirements or the working capital requirement, which are needed for short-term financial requirement, which will meet the operational expenditures of the company. Now, sources of finance can also be classified under various categories. If it's based on the period, then we are saying long-term sources. That's when the finance is mobilized with large amount and repayable over the period with more than 5 years. The repayment period is more than 5 years. So it will be considered a long-term source. So such sources include equity shares, preference shares, debentures, long-term loans, fixed deposits. And we have short-term sources. So they are needed to meet the operational expenditure of the business concern. And sources include bank credit, customer advances, trade credit, factoring, public deposits, and money market instruments, which we looked at in the previous slides. If the finance is also classified based on ownership, then we have the ownership sources, which include share capital, retained earnings, surplus and profit, or borrowed capital, which are from external parties, such as debentures, bonds, public deposits, loans from banks, and financial instruments. Now we'll go into Islamic financing, which refers to how businesses and individuals raise capital in accordance with the Sharia or Islamic law. So it can be seen as a unique form of socially responsible investment. Now, types of products under Islamic financing, we have one, paying or charging an interest. So Islam considers lending with interest payments as an exploitative practice that favors the lender at the expense of the borrower. So according to the Sharia law, interest is usury, which is strictly prohibited. Investing in businesses involved in prohibited activities. So some activities such as producing and selling alcohol or pork are prohibited in Islam. These activities are considered haram or forbidden. Therefore, investing in such activities is likewise forbidden. We have speculation or maisir, where Sharia strictly prohibits any form of speculation or gambling, which is called Maisir. Thus, Islamic financial institutions cannot be involved in contracts where the ownership of goods depends on an uncertain event in the future. The fourth one is uncertainty and risk, or GARA. The rules of Islamic finance ban participation in contracts with excessive risk and/or uncertainty. The term GARA measures the legitimacy of risk or uncertainty in investment. So GARA is observed with derivative contracts and short selling, which are forbidden in Islam finance. So in addition to these various prohibitions, Islamic finance is based on two crucial principles. So the first one is material finality of the transaction, where each transaction must be related to a real underlying economic transaction. And the second one is profit or loss sharing, where parties entering into the contract in Islamic finance, they share the profit or loss and risk associated with the transaction. So no one can benefit from the transaction more than the other party. And types of financing arrangements, we have the profit and loss sharing partnership, Mudaraba, where is a profit or loss and loss sharing partnership agreement where one partner known as the financier provides the capital to another partner known as the labor provider, who is responsible for the management and investment of the capital. The profits are shared between the parties according to a pre-agreed ratio. The second one is profit and loss sharing joint venture, Musharaka, is a form of joint venture where all partners contribute capital and share the profit and loss on a pro rata basis. So the major types of these joint ventures are diminishing partnership, is a type of venture which is commonly used to acquire properties. The bank and investor jointly purchase a property, and subsequently the bank gradually transfers its portion of equity in the property to the investor in exchange for payment. Then permanent musharaka, where this type of joint venture does not have a specific end date and continues operating as long as the participating parties agree to continue their operation. So generally, it's used to finance long-term projects. The third one is leasing, ijara. So in this type of financing agreement, the lessor, who must own the property, leases the property to the lessee in exchange for a stream of rental and purchase payment, ending with the transfer of property ownership to the lessee. Now we go to investment vehicles under Islamic financing. So the first one is equities. So Sharia allows investment in company shares. However, the companies must not be involved in activities prohibited by Islamic law, such as lending at interest, gambling, production of alcohol or pork. Islamic financing also allows private equity investment. Now, the second one is fixed income instrument, which is an investment vehicle. So since lending with interest payment is forbidden by Sharia, there are no conventional bonds in Islamic finance. However, there is an equivalent of bond called the sukuk or Sharia compliant bond. So the bonds represent partial ownership in an asset, not a debt obligation. So advantages of Islamic financing, there is fairness in dealing. So the basis of Islamic banking is the profit and loss sharing principle. There is also ethical and moral dimension, where Islam emphasizes on being gentle and honest in transaction. Now, there is stability in investments. It emphasizes building a stronger investor-entrepreneur relationship rather than creating that of a lender-borrower relationship. There is also reduced impact of harmful products and services, where the Islamic financing prevents investment or dealing in products or services that are declared haram or forbidden by the laws of Sharia. But then there are some disadvantages. The ideal investment models are not convenient. Mudaraba and Musharaka models are considered to be the heart of Islamic banking, but are not as effective as they should be due to a lack of committed and faithful entrepreneurs and professionals who can create innovative products. There's also the absence of liquidity instruments such as T-bills and other market securities, and they are used to manage the problems of liquidity shortages and excess. But many Islamic banks lack such liquidity instruments. There's also an absence of advanced technology and media, where several Islamic banks lack the expertise for research and development. Now there's approach and innovation. Many practices are also yet to be modified according to the needs and requirements of customers. Now, there are many advancements which are currently ongoing in the area of Islamic financing, and some of these disadvantages may not apply. Now, we'll move on to capital structure, and we are saying it refers to the kind of securities and the proportionate amounts that make up capitalization. So it's a mix of different sources of long-term sources, such as equity shares, preference shares, debentures, long-term loans, and retained earnings. It's a permanent financing of the company, represented primarily by long-term debts and equity. So when we are looking at capital structure, we also have the optimum capital structure, which is defined as a capital structure or combination of debt and equity that will lead to the maximum value of the firm. A mix of debt or equity that will create the maximum value of the firm. Now, some objectives of the decision of capital structure is that one, we want to maximize the value of the firm, minimize the overall cost of capital. Now, forms of capital structure could be equity shares only, preference and equity shares, equity and debentures only, equity shares, preference and debentures. Factors that will determine the capital structure to be selected by a company, we have one, leverage, which is the use of debt or borrowed funds to amplify returns from an investment or project. Cost of capital, which encompasses the cost of both equity and debt, weighted according to the company's preferred or existing capital structure, and the government policy applicable during that decision-making process. So we have the traditional approach, which according to that, a mix of debt and equity can increase the value of the firm by reducing the overall cost of capital to a certain level of debt. Now, when cost of capital reduces, then the value of the firm increases. There is that opposite relation between these two items. So the traditional approach says that the cost of capital decreases only within responsible limits of financial leverage and when reaching the minimum level. So there are certain assumptions. So there are only two sources of funds used by a firm, which is the debt and shares. The firm will pay 100% of its earnings as dividends. The total assets are given and do not change. The total finance remains constant. So these are some of the assumptions under the traditional approach of capital structure. And we have the M&M approach. So the Modigliani and Miller approach. So this approach says that financing decisions of a firm does not affect the market value of the firm in a perfect capital market. So they maintain that the average cost of capital does not change with the change in the debt and then the equity mix of the firm. So there are certain assumptions under the M&M. So there is a perfect capital market. There are no retained earnings, no corporate taxes. Investors also act rationally. And to find the value of the firm, it is the earning before interest and tax divided by the KO, which is the overall cost of capital, and we take care of our tax components as well. When we go to financial and operating gearing ratio. So gearing refers to the relationship or ratio of a company's debt to equity and shows the extent to which a firm's operations are funded by the lenders versus the shareholders. So when the proportion of debt to equity is great, then a business may be thought of as being highly geared or highly leveraged. So a high gearing ratio typically indicates a high degree of leverage, although this does not always indicate a company is in poor financial condition. So instead, a company with a high gearing ratio has a riskier financing structure than a company with a lower gearing ratio. Leverage refers to the ability to use the fixed cost assets or funds to increase the return to shareholders. So that's leverage. How do you use this gearing ratio? So for gearing ratio, we assume that a company has we benchmark this figure, against the gearing ratio of another company, or we compare it to the company's prior year performance. So let's assume that a company has a debt ratio of 0.6, although the figure alone provides some information as to the company financing structure. It is more meaningful when you compare this 0.6 gearing ratio against another company in the same industry. Say another company who has a gearing ratio of 0.3, and then let's say the prior year gearing ratio was 0.9, and then an industry average of 0.8. So you then, based on this, to make a decision as to whether the company is performing well or not. So let's say the gearing ratio prior year was 0.3. Current year is 0.6. Industry average is 0.8. And the main competitor is 0.9. So obviously, with a 0.6 ratio, industry is 0.8, then you can say the company is performing well and does not have a very riskier capital structure. Okay, so operating leverage. So this is associated with investment activity. Is the company's ability to use the fixed operating cost to magnify the effect of changes in sales on its earnings before interest and tax. Hence, it consists of fixed costs and variable costs. So when a company is said to have a high degree of operating leverage, it employs a great amount of fixed costs and smaller amount of variable costs. That's the degree of operating leverage depends upon the amount of various cost structures. Operating leverage can be calculated by OL is equal to C over OP, where OL is the operating leverage, C is the contribution, OP is the operating profit. Degree of operating leverage is equal to percentage change in operating profit over percentage change in sales revenue. So where DOL is equal to degree of operating leverage. So DOL assesses the volatility in operating profit to changes in revenue. So it is high when the firm uses more fixed costs than variable costs in its operating cost structure. So the use of operating leverage, so it helps to identify the position of fixed costs and variable costs. It also helps us to know the relationship between the sales and revenue of the company during a particular period. And it can help us understand the level of fixed costs which is invested in the operating expenses of the business. Operating leverage describes the overall position of the fixed operating costs. Now, financial and operating leverage ratios. So we'll determine the degree of operating leverage and explain the implication. So let's say a company A and a company B. Company A has a sales of 2.5 million. Company B has a sales of 3 million. Fixed cost for company A is 750,000 and that of company B is 1.5 million. Variable expenses as a percentage of sales are 50% and 25% for company A and B respectively. Okay, so we are being asked to find the operating leverage. So for operating leverage, we need a contribution over operating profit. And we know our contribution to be our sales minus our variable cost. So we need to deduce the variable cost. Now the scenario gives us a variable expenses as a percentage of sales, 50% and 25% for company A and B, meaning that for company A, variable cost will be 50% of the 2.5 million, which is 1.25 million. And for company B, it's going to be 25% of the sales, that's 25% of 3 million, which is 750,000, giving us a contribution of 1.25 million and 2.25 million for A and B respectively. Now that is our contribution, which we put in the equation. Now the other thing we need to find is operating profit. So contribution minus fixed cost is our operating profit, which is 500,000 and 750,000 for company A and B respectively. So our operating leverage for A is 2.5 and operating leverage for B is 3. So operating leverage for company B is higher than that of company A. So company B has a higher degree of operating risk. The tendency that operating profit may vary proportionately with sales is higher for company B as compared to company A. Okay, so we go to financial leverage, which is the ability of a firm to use fixed financial charges to magnify the effect of changes in EBIT on the earnings per share. So it involves the use of funds obtained at a fixed cost in the hope of increasing the return to the shareholders. It can be favorable or unfavorable. Now, favorable or positive financial leverage occurs when the company earns more on the assets purchased with the funds than the fixed cost of their use. And unfavorable or negative financial leverage occurs when the company does not earn as much as the funds cost. So financial leverage can be calculated by OP over PBT, where FL is the financial leverage, OP is the operating profit, PBT is profit before tax, or we can calculate financial leverage by EBIT over EPS, where EBIT is the earning before interest and tax, EPS is the earnings per share. Now the degree of financial leverage is the percentage change in taxable income over percentage change in earnings before interest and tax. Now, financial leverage locates the correct profitable financial decision regarding the capital structure of the company. It also measures fixed cost proportion with the total capital of the company. So we'll look at an example. A company has a structure of equity share capital being 100,000, 10% preference share capital of 100,000, 8% debentures of 125,000. So the capital structure of the entity is such that it includes the equity shares, preference shares, and debentures. The present EBIT is 50,000, so we should calculate the financial leverage, assuming that the company is in 50% tax bracket. So to find financial leverage, we need the operating profit and the profit before tax. And our EBIT is given, or the operating profit is giving us is 50,000 as given in the question. Now we need to find the profit before tax. So our interest on debentures is 8% of our 125,000, which is 10,000. Our earnings before tax then becomes our EBIT minus our interest, which is 40,000. And then our income tax is 50%, which is 20,000. 50% of the earnings before tax, which is 20,000, giving us a profit of 20,000. So our financial leverage is operating profit divided by the profit before tax, which is 50,000 divided by 40,000 of 1.25. So this can also be compared to that of another entity or its prior year performance to tell whether the financial leverage is more riskier or not. Thank you very much for staying with me to this point. Kindly follow the link below to join the Telegram channel created for the paper, where you can have access to the slides and other relevant material to aid in your preparation. Thank you, and I'll see you in the next session.